Persistence is my big one. No matter what, don't give up. Don't worry about what everyone else is posting on social media. Y'all know those Facebook stories aren't true. Come on. We all know that.
Or only maybe very partially true.
I mean, it's very partially true, right?
Yeah.
It's never the whole picture. So don't worry about somebody else so-called trailblazing at, 2 deals a week or something like that.
Welcome to the Real Estate Mindset Podcast, hosted by Eric Nelson and brought to you by Wild Oak Capital. Eric is a real estate investor, business owner, and performance coach. Throughout this series, Eric explores the mindset behind why certain investors are so successful and how we can learn from their achievements and failures. Eric asks the tough questions around the habits, discipline, mindset, and more required to achieve the most ambitious goals. Thank you for being here and enjoy the show.
Hey everybody, welcome to the Real Estate Mindset Podcast. This is your host, Eric Nelson. And once again, I've invited my brother, Ben Nelson, to be a co-host today. So thank you for being here, Ben.
Thanks for having me. I'm excited to do it.
Yeah, we have an amazing guest today, Sandhya Seshadri. I think I said that right. Thank you so much for being here. We really appreciate it. And I think we'll just jump right in the pre-show. We talked about this. Can you kind of give us your background, where you're from, how you got started, and then what took you to real estate?
So I'm like your typical Indian geek, right? I go to school, I get my good grades, so I get into college, I become an engineer. That's what we all do, right? You get into engineering or you get into medical field, right? So I picked engineering, went to college and got a job, worked the corporate world for a corporate Fortune 500 company here in the Dallas area. Realized that all the business folks are making all the decisions and telling me what to do, and didn't like that one bit. So went ahead and got myself an MBA and part-time while working my full-time engineering job, and got into more of the business side and the program management side, and realized after a while that playing around with the stock market was pretty fun. And then I had children, and so I went full-time into the stock market and quit the corporate rat race. Kept doing that for a while and realized, okay, I'm paying too much in taxes. How do I get to the point where I pay less in taxes? And when the previous president, Donald Trump, I heard has never paid much in taxes, I was like, I need to get into real estate in some way. But single family just wasn't the way to go, because I didn't grow up with a dad who was a handy person. And I didn't want to be called to fix toilets, etc. So when a friend told me about multifamily investing, where you can buy large apartments through this process called syndication, where you pool other people's money to make the down payment on a large $10 million apartment, and you can hire a property management company to do all the work for you. That's when it started making sense, so that I would be looking at spreadsheets, doing my asset management, visiting the property as needed, but not having to be there day to day, looking at leases and taking care of residents and maintenance issues. So that's when it all made sense, and that's where I am. So I started this journey back in the end of 2018. So a little over 2.5 years, I would say, in the multifamily business in Dallas predominantly.
Awesome.
Yeah, so that was going to be my question, is how you jumped into, and if you started in Dallas, and do you invest in the market where you live in?
Yes, I've lived here for over 30 years. This is the market, neighborhood, streets, everything that I know. So even my passive investments, by the way, I'm invested passively in 20 deals and actively in 3 deals. So passive investing was my way to learn the business, build relationships with sponsors who are doing what I want to do, and learn from them by observing, by being an active passive investor, as I call it, and then got the confidence to syndicate my own deals. So syndicated my first deal back in August of 2019, and since then a couple of more.
Yeah, so I've had a handful of guests on the show that had a similar path to you, where they start as an LP or limited partner, or what we'll call a passive investor, and then make that transition eventually to be a GP. And that seems to be a really cool way to do it. I mean, you can jump in and learn the business, and you really are hands off. I mean, you're kind of just trusting the general partnership to do a good job. And I heard you on another podcast talk about this, so I want to circle back. But being a limited partner is a great way to learn. And the other thing I wanted to mention before I move too fast was, you mentioned that you got an MBA while doing a full-time engineering job. So that's amazing. So first off, well done. And that's a lot of hard work. And then the other thing you mentioned was the stock market. And I love to ask guests about what your experience of putting your cash in the stock market versus passive investing in real estate. And yes, it's a huge tax benefit, but beyond that, what have you seen gains wise versus, both have done pretty well in the last 10 years, but what is your experience in those two different realms?
So my passive investing journey in multifamily only began in the end of 2018. So I only have 2 years of data on that. And unfortunately, one of the years was COVID, all of 2020 predominantly. So the last 12 months has been COVID. So some of the deals have not done so well in terms of cash flow, but the appreciation has helped them come through. So I've had a couple of deals go full cycle, and I've been able to get a very good return on my real estate portfolio that way. Now, I did do some hard money loans, and those paid even better. Those were short term. Those were more risky, but they invested in multifamily or assets that I could, like mobile home parks, et cetera, but on a short term lending. And those paid off really well. The stock market. Now, I was one of those people who had a small amount of stock, not a huge amount. I wish I'd bet everything on it, but I did have some Tesla. I always believe in companies like Apple, Walmart, just very standard blue chip companies that you can't go wrong with. So I've done very well with the stock market. But where real estate comes in is the tax adjusted returns. So when you take into account the tax adjusted returns, I mean, real estate is a no brainer.
Yeah, I totally agree. Especially if you're going to continue, right? If you utilize either a 1031 or some other method, or you're just planning for long-term returns. Yeah, completely agree. And then the one thing I wanted to mention too is you mentioned you just got into this, and to be into 20 deals passively and 3 active passively. I love that term. That's really cool. I mean, that's a big jump. So kudos to you for diving all in. I mean, I think a lot of people are, say, how can I scale faster? And that's what's so cool about syndication. But well done. And would you, I guess the question I'm driving at here is, would you have done anything different in that investment, or would you have done it faster or differently in your transition to real estate?
I actually wish I'd put more into Tesla like everybody else, or Bitcoin or something. Sure. So besides all of that, I think that passive investing is the way I got comfortable with then taking on the responsibility of doing my own deal. Now, the problem is that with syndications, you are responsible as a GP for other people's money, which is a huge responsibility. So, I worked in the corporate world. I know how hard I had to work to make my money. So I take it very seriously when people from, all their walks of life give me their retirement money, education IRA money, or the money they earned in the, business world, corporate world, running their small business. So that's where I had earned money in the corporate world, and it was in my old 401k. I was able to roll that over, and that's why I had so many passive investments. Is that's money that I didn't want to remove out of my retirement account. So I left it there and invested passively in deals, thereby building relationships with a bunch of sponsors. What would I have done differently? I would have understood a little more probably about the tax benefits and depreciation, and tried to talk to an accountant, pay a real estate accountant the big bucks up front and say, okay, does it really make sense for me to do this many passive deals? Or should I try to roll over some of them, or actually withdraw some of them because of the bonus depreciation benefits associated with it, to where I pay very little in penalty, and probably taken another bigger chunk out and done my own deal. But as far as doing your own deals and taking other people's money, the other way I've seen people do it is they do small deals where they can fund the entire deal themselves. But then it's hard to be able to have the economies of scale to have a property management company run it for you. So in that sense, my first deal, my second deal, my third deal, they're all the perfect sizes for that. So I wouldn't have changed any of that.
Yeah, if you wouldn't mind elaborating on that a little bit, what do you mean by the perfect size deal? What's a perfect size deal for you, and how does that translate into your experience and what you've seen?
My first deal was 86 doors and $6.75 million. So our raise was about 2.4 if you think about the down payment plus the rehab money. So that was a reasonable size to raise for between 3 of us for a first deal. For me, at least, it was a first deal. My partners had a little more experience, so I was able to leverage their resume. At 86 doors, if you run the numbers and the property management company gives you a budget, that's the right size for which you can afford to have a full-time leasing manager and a full-time maintenance staff on site instead of having to share them across properties. At 50 doors, you may have to share and things like that. So I like having, 2 full-time staff on site. And then you can always bring in extra crew as needed if you have a bunch of make-readies to do a bunch of unit turns, et cetera, all at once. So that's what I meant by the perfect size. 50 doors is too little. And, if I got more than 150 doors, that would have been a larger amount of capital to raise for a first deal. So that's why I felt like it was that Goldilocks perfect size.
Yeah, I mean, I think it really is. We talk about this a lot. I mean, where's kind of a sweet spot, especially to get started? Where's the good spot for a first deal? Seemingly 100 doors or more, there's a little bit more competition.
Yes.
Seemingly under 80 doors, exactly. You can't really afford to have full-time management or staff there.
Yeah.
So I kind of like that size, and it's cool that you found it. So you mentioned that you're in Dallas and you invest there. Do you look in any other markets, or is that specifically where you want to continue to invest?
I'm going to continue to invest here. It's like I drank the Kool-Aid here. I'm a huge fan of Dallas. You can't convince me that there's a better market just yet. I see the population growth, the job growth. Those are the two huge indicators of the expansion happening in Dallas. But another interesting point is that when you think about new builds, right, construction, through 2020, we had maybe 40% less permits done than compared to 2019. So what that means is in 2 years, around the end of 2022, 2023, you're going to have lesser supply of new builds, of units to rent for people. So your Class A's are going to be more expensive. So Class A is a brand new build or something built within the last few years versus a Class B, something built in the 80s and up. And Class C is even older than that. So that trickles down as the demand, there's a greater demand than supply. So anyone buying an apartment today in the Dallas area, as long as you manage it reasonably well and it's in a low crime area, you can't help but appreciate in 2 to 3 years. I mean, that's almost a no-brainer. So I'm very bullish about the Dallas market, but I think the Sun Belt is great. So I would definitely bet on Phoenix and Atlanta as well. I would add to that list. The Carolinas, I don't know enough about it, but I know a lot of people I respect are doing very well there. So I would add that to the list in terms of markets.
Yeah, I completely agree. I mean, Dallas, obviously, it's an outstanding market. I think the one thing I would say is it's also very competitive. It's competitive for a reason, right? I mean, everyone looks at that market and says, wow, that's really cool. So before we move on, I do want to jump back actually and talk about something you mentioned before, was taking some 401k money and investing passively. Did you keep it in a 401k and have a custodian? And can you speak to your experience with that?
I did the SD IRA, the self-directed IRA briefly, but then when I realized one of my deals was going to complete a full cycle and I'd have to pay additional UBIT taxes, I rolled it into a solo 401k, a type of solo 401k. And I actually went with EQRP by Damian Lupo, but there are several others in the market that my friends have used. So I would say do your homework to see which one you qualify for and the costs associated with it and how much you have to do versus how much they, hands-free do it for you. And that's where the pricing difference comes in.
I think that seems to be the magic mustard, right? You talk a lot about doing your research and knowing what you're getting into.
Yeah. And it gives you checkbook control. So literally, if you told me I have to write a check for an investment today, I just pull it out and write my check. So it's that easy. So you have that convenience instead of having to wait and send all the paperwork to your custodian. And then it's several business days before they can send the money.
And I guess we, might as well get into this a little bit. Was the cost to transfer to a solo 401k, was it a reasonable cost to make that transition, or is it kind of pay itself back over time? Does that make sense?
You mean the cost of opening a solo 401k account?
Well, was there a cost associated with transferring from your self-directed IRA to the solo?
Yeah, it's like a 3-4k kind of setup fee and then an annual maintenance fee, but you might pay even less with some other companies.
Yeah. And I think, that answers my question. I mean, something like that could pay itself back fairly quickly. I mean, that's a lot of, So that's a
no-brainer for me. For the volume that I had, I definitely had to do it.
Okay.
Otherwise, I didn't want to pay those taxes.
Totally understand. So I heard you on another podcast discuss your feelings on the acquisition fees. And so I'm wondering if you can dive into that a little bit, give us your thoughts on that, and then just kind of discuss your thinking on the acquisition fee, if you don't mind.
So I'm in a very competitive market, and sometimes I spend weeks, months going after deals, and I don't get awarded any. There is always that one buyer, 1031 exchange buyer, someone from out of state, New York, California, writes that big check, puts 1 million hard money down day one. So I spend months trying for these deals, and I lose them, and I don't win a deal for a long time. So I know that all those months I'm not really getting paid. So I understand the reasoning behind acquisition fees. My problem with acquisition fee is if you have a large deal, like $50 million deal, and the sponsorship is taking like 3-4% acquisition fee, that's a huge amount of money. And my point is that they have no money left in the deal after closing. So, 3% on a $50 million deal, that's a huge amount of money, right? 1.5 million. So even if they spread it across 5 or 6 different sponsors at $250K each, you don't have any money left in the deal typically after it closes. So they're not taking a financial risk. Obviously, they risk their reputation if the deal goes badly, et cetera. But I'd like for a sponsor to have at least the minimum invested, like a passive investor. So if the minimum is 50K, I want to see every GP have at least that 50K left in the deal after closing and after taking their acquisition fee. So if they take an acquisition fee of 100K, I'd like them to put in 150K in the deal so they still have 50K money in the deal.
Yeah, I agree. Go ahead, Ben.
So I was just going to say, is this based on your experience? You mentioned you actually have been a part of many as an LP and as a passive. Is this something that, the taste in your mouth is from some of the deals you've been in as a passive investor? And to kind of piggyback that, are there any other mistakes that you've sort of seen or any lessons that you've learned that you'd love to pass on in addition to your particularities as far as acquisition fees are concerned?
Yes, I have a long passive investors checklist to vet a sponsorship team, the 11 mistakes to avoid when investing in a deal that I can share with any of the listeners. And I can certainly touch on a few of them. But my website is multifamilyforyou.com, where it's a number 4 and YOU.com. If they provide their name, email, and ask for the checklist, they can receive it free. It doesn't automatically add them to any database, so there's no risk of spam unless they want to hear from me again. But one of the mistakes is that I made is that I invested in a deal where there was a very large acquisition fee involved. And the sponsorship team didn't really care afterwards whether they made money or not, because they've already walked away with their money once the deal closed. So they're out there constantly raising capital for new deals, deal after deal after deal. And I'm like, who's running this asset? Why is it doing so badly? Why are you spending this huge amount of CapEx in second quarter of 2020 when we know COVID hit in March? I mean, I stopped all projects at my properties so I could wait and see what the delinquency was going to be before I spent any more money. But this group didn't. So guess what? They ended up making what's called a capital call afterwards in third quarter after having spent millions of dollars on exterior projects that weren't necessary. And then when I sort of complained about it, they changed it to a member loan so that they don't dilute the shares. But they still needed money to even pay their debt service. It was doing that badly. So I worry about people who don't have any asset management experience and sound perfect on social media, have the most perfect websites, and, they are perfect in every possible way and are in every conference and even promoted by all the big leaders of multifamily. But they have no asset management experience. They haven't actually completed a full cycle on a deal or know what to do when a pandemic hits. So I really want to know, if I'm a passive investor in a deal, how did your deals do through the pandemic in 2020? Please give me a list of the deals that you've done. And for every deal that you've done, I want a reference for a passive investor. Deal A in Dallas, deal B in Atlanta, deal C in Phoenix. Please send me a passive investor for every one of those deals who I can speak with privately. And here's my questionnaire. And if you pass this test, I'll consider investing in your next deal.
Yeah, that's such a good tip. I mean, that's a great list of things to ask, even those handful of things. Mm-hmm. It kind of comes back full circle is do your homework. Kind of pay attention to who the sponsor is, pay attention to who you're dealing with. I love those tips of ask the questions. Someone could look really shiny on social media, but that doesn't mean they're going to be a good manager. So I wanted to ask the question about the acquisition fee, because I have a similar belief that if the deal is large enough, the acquisition fee needs to kind of match that. 3% on anything over $20 million is just so much money. And then you do want to see them put some of their own skin in the game. So whether it means you put the acquisition fee totally back in or whatever it might be, And the reason I brought it up is because it's important to know as a passive investor, your sponsorship team needs to follow the business that they put in front of the deal, right? So if they have this giant fee, just like you said, that's a big amount of money before they've really done the work. And there's a lot of work to get a deal, as you mentioned. So there does need to be some payback, but the important thing as the investor is that they can follow through the business plan. So that's the reason I brought it up. And that's such great tips. So I really appreciate it.
Yeah, along the same lines, think about how much time you spent before you bought your last appliance or car. Don't you think a 50K or greater investment deserves at least that much scrutiny?
That's
Yeah.
so true. That's so funny that you say that, because that's true. And just taking the time in your own personal life or comparing it to some big actions and action items in your own life. And so with this, I'd love to learn a little bit. We talked about how you jumped in, but sounds like now you've got a couple of general partners that you work with. Is there anybody that you jumped on with as far as mentorship and people that kind of are stewarding this process and teaching you as you go along? We're really big on how do we teach each other and mentorship. Can you speak anything to that as in people that you work with?
Yes. So when I started this journey in the end of 2018, I joined the Brad Sumrock mentoring program, which is based in Dallas. I went to one of his rat race events. I realized this is exactly what I wanted to do. I love the energy. And most importantly, these are people doing things that I want to do in the market that I'm interested in. So they already have the connections. So even the first time when I was pretty clueless and went on a tour with a broker, if I mentioned to him that I'm from the Sumrock group, I immediately got so much respect. They took me seriously. They knew, okay, someone from this group has done their homework, at least in terms of underwriting, and I know that they can close a deal. So it immediately gave me that card, to sort of earn the broker's respect and ask questions. And I got better at it. And once I closed my first deal, it was easy. It just like a slide from then on as far as talking to brokers and getting the real truths and the true conversations began to happen.
Yeah, I can't really give up too much information, but we did put an LOI in on a deal and lost the deal to a Brad Sumrock group.
Oh,
and
sorry.
The reason I bring it up is because if you're going to lose a deal, especially in the Dallas area, that's who you kind of want to lose it to. A group that comes through, it seems like they're kind of far reaching in that zone. But the reason we always ask that question is about mentorships and if it was worth it to pay for that and worth it to pay for, any kind of program like that. So haven't had anyone say it's not worth it yet. So we really enjoy that question.
Yeah, I'm big on self-development and spending the money every year on doing something. So the first couple of years, I mainly focused on that mentoring program, but I also joined masterminds. I think that self-improvement and always networking with people who think differently from you is very important, because I know everyone says like-minded people, and that's great, but you want different ideas. So you don't want everyone thinking of underwriting a deal only a certain way or looking at a market only a certain way. You want to be challenged. So I would definitely encourage people to invest in masterminds, not just within real estate, but also just professional, business building, entrepreneurship kind of masterminds.
Yeah, I completely agree. I mean, that's the reason I started this podcast is I just love the mindset stuff. I love just kind of thinking, how can you become better daily? And so I completely agree with what you just said. So we'll actually kind of transition. We have a handful more mindset specific questions. So this might seem like a big leap, but I ask these questions to every guest. So my first question for you is, do you have a morning routine?
I do. And it's all about waking up in the morning. I try to do the miracle morning and I don't follow it exactly, but I'm trying to do the 15 minutes of reading every day and at least 10 minutes of exercise every morning. And then I'm always tempted to go to my phone. So I say, I don't get my phone time unless I do at least one of these two things. I'm pretty addicted to my phone. So the way I console myself is I play some podcast on the phone while I do a little bit of a workout, because health and fitness is something I really need in my life. I probably say that's my biggest weakness. And so that's what I'm trying to improve. So that's my morning routine, is as tempting as it is to dive right into work. I try to do that and spend some time with my family. I have a school age kid. And then after that, I come back, and then I'm trying to do more with my laptop rather than the phone screen.
Very good. Yeah, that's a great answer. I mean, I think to one, recognize your weakness and say, hey, here's the one thing I want to improve. And it's exactly what we were just talking about. And then two, say, hey, this thing, whatever it might be, phone, whatever you're kind of addicted to, I don't get that until I finish this routine. It's pretty powerful. So yeah, with kids, I mean, everything's kind of a juggle, but great answer.
Yeah, I think also for me, it's the same way. So waking up and working out in the morning has changed quite a bit. And I think COVID has reset everybody, right? And depending on how you work and how you interact with your family. So for my wife and I, that's been something we've put in place. We've always kind of worked out, but being able to get up in the morning, I find I'm far more focused and I'm far clearer on what I want to do with my day after that. It just really jumpstarts the day in the right way for sure. So that's interesting. Moving to the next thing is really learning about, you're talking about habits and about learning. And are there any books or resources that you utilize or that you've read in the past, or anything that really has driven your journey forward?
I love the Atomic Habits because it really teaches you, especially since I'm into math, it teaches you the exponential power of making a very tiny incremental change on a positive daily habit every day. Like I said, I'm only trying for that 10 minutes. So if I told myself I have to work out for a whole hour before I touch my phone, I may not quite do that. But if I say it's only 10 minutes and I literally put a timer or say it's 4 songs worth, or something like that, then I do it, right? And then I treat myself to it. Then I'm like, okay, now I can be listening to a podcast on my phone. So I'm still with my phone and then I do my walk. So, making incremental positive changes has a huge impact. And so does actually tiny negative habits as they creep up on you. Has a huge detrimental effect as well, 6 months later or a year later. So I'm really trying to follow that mindset in that book.
Yeah, I love that book. Manny McAllister, I don't know if you know her from MFM, but she turned me on to that book. I'm still only about halfway through. I kind of listened to it in pieces and parts, but it's super powerful. I mean, yeah, exactly. Little tiny changes can make massive improvement over time. So great recommendation. And we've gone through quite a bit of these, but the next question would be, do you have any mindset tips that you can give folks that are just starting out?
Persistence is my big one. No matter what, don't give up. Don't worry about what everyone else is posting on social media. Y'all know those Facebook stories aren't true. Come on. We all know that.
Or only maybe very partially true.
I mean, it's very partially true, right? It's never the whole picture. So don't worry about somebody else so-called trailblazing at, 2 deals a week or something like that. You go at your pace, at what makes sense for you, at what you're comfortable with. And for me, for example, that was several passive deals before I did my first syndication, because I really was very concerned about other people trusting me with their hard-earned money. And for me to take that responsibility, I needed to get my feet wet a little more with a zero real estate background. So there's probably somebody else who in 3 months had, 3 deals. And I took 8 months and I had 1 deal, and that's okay. So go at your pace, but persist. Even if it's incremental progress, like I said about the, Atomic Habits book, as long as you're still progressing in the right direction, slow and steady can win the race.
Well, and on that, so just curious, what was it that made you feel comfortable enough to become the lead, to actually take the step to move from passive investing to active, to take a step forward? Where did you decide that it was time?
Well, I was a passive investor in several deals, and I was very actively asking questions every time I read reports. And I felt like, this makes sense. This is just basic math. This is just like running a business, et cetera, to where, I could do this. So then my first deal, I partnered with people with more experience than me so that I still had a fallback. It wasn't all just my ideas. It's one thing to say, yeah, I can do it. I'm going to do it. Versus saying, oh, this is other people's money. I need to be more cautious. And so let's have some sounding boards here. Let's have additional partners who have the experience that I don't, and let's leverage that. And so as I went on, weekly property management calls, executing your business plan, CapEx, you realize, oh my gosh, this isn't as hard as I thought it would be. This is pretty straightforward. Do exactly what you planned and it's going to work. And it did in most cases, right? Some projects were slightly late. Some projects were slightly over budget, but it wasn't significantly different. And in fact, when you have a first deal that's doing really, really well, it really boosts your confidence. And that's, it's a matter of combination of both luck and, persistence and hard work. All of it came together. So.
Yeah, you said a couple of things in there. One was, you said it a few times, was taking care of other people's money. And so that's something I believe in so strongly. I have this kind of feeling that someone else's money, I'm going to pay more attention than even my own by a long margin. So I'm glad you mentioned that. Totally agree. I mean, that's what you want in a sponsor, is someone who just says, okay, holy cow, this is a responsibility. This is just not like something else, or you're investing my own money. And then, yeah, I mean, I love the persistence answer. It's basically like continue forward. It's set the plan in motion and then stick it through. I mean, stick to your plan, and it should follow through, like you said. So really appreciate that answer. So the next one would be, this one's a little bit more difficult to me, is what is your definition of success?
For me, success is freedom of time, freedom to do whatever I want, whenever I want, without having to answer to anyone. And you do that by managing your income, controlling your expenses, so you have financial freedom. And for me, getting out of the corporate rat race, doing the stock market and now real estate, I get to pick my hours. That's why I'm not doing 12 active deals a year where I'm the sponsor, but it's several passive deals and then a couple of active deals. So it's the right balance for me of work life. So I have time for the things that I love to do, like travel and family time, but I'm also actively helping change lives and communities with all the initiatives that we do at our properties.
Yeah, such a good answer. I mean, I find money to be a tool, and I've said this a lot of times. Is you know, money is basically just that. It's basically a way to either have freedom or hopefully, you know, depending on the person, help other people. So to use that in a way of good, and then to use that tool to gain what you just said. And your definition is have the freedom to do what you want when you want, and it's just a tool to get you there. So really love that answer. And then part two of that is, why do you think that you are successful, you specifically, and others not so much?
I would say my biggest strength is that if one path closes, I just find another path. I don't worry about, oh, this is the road the person ahead of me has traveled. That's okay. I may have to deviate. I may have to go a completely different route to get to my destination, which could be, my own way. So just like when I came to the United States, I was in India, and my parents made about $60 a month in salary. And I wanted to come to college here for $20,000 a year. It's going to take many, many years for my parents to make that kind of money. So the straight traditional path of, oh, let me apply to college and we can pay for it, isn't going to work. I had to actually get a scholarship before I could even think of coming here. And so I had to figure out, okay, how do I get a scholarship? Not, oh my gosh, that's too expensive, I could never afford it. It's more of, okay, how do I make that happen? What does it take if this path isn't going to work? And so I would say persistence and always finding a way to get there without following someone else's path.
I would say, I mean, that's such good stuff. And I love what's the saying is, it's not if I can do it, it's how I can do it kind of thing. It's like there's a way to get there, you know? And rather than just give up, rather than just say I can't, or rather I say, you know, in your case, your parents can afford it or whatever it might be, it's how can I afford it and how can I get there? So that's an amazing tip.
There's an old saying that I've heard a bunch of times, and I think Eric and I have traded this a bunch of times, is that success is a terrible teacher, right? It's the things that when it gets hard, when you learn and you actually fall down a little bit or you make a mistake, that's when you learn the most, right? Yeah. So actually, I'd be curious, if you could point out, what do you think your biggest mistake has been so far? And what have you learned from that? And how can we help other people avoid that pitfall?
Trusting someone based on their social media profile, which tends to be all self-promotion, rather than digging deeper to really look at their experience, ask for references of other people who've invested with them, etc., and then choosing to invest my hard-earned money. Because right now, I'm not sure if I'll get my principal back on that deal, but the fact that I have nagged them on a very regular basis to the point where they had to unfriend me on Facebook, my annoying them has now made them list the property for sale. So hopefully now that it's listed for sale, we're going to get at least our principal back. But sometimes that's what you have to do. You have to be that one person who speaks up among a sea of all of these folks who don't, who either are blind to the financials they've been sent every month, or somehow are too afraid to protest because this person looks so perfect on social media. How could they possibly be wrong?
So there's your persistence again, coming back, right?
I encourage everyone to definitely do your homework before investing your hard-earned money with anyone. And I'm speaking as a longtime passive investor and now active investor. So I can see it from both sides.
Right. Well, you actually mentioned that you have a checklist for this, right? Is there? Would you mind saying your website again, and how people get in touch with you, and if there's anything that our listeners can bring to you, if there's anything that they can do to help you as well?
Yeah, my website is multifamilyforyou.com, where the 4 is the number 4 and U is YOU spelled out. And you could put your email address, name, and write a little comment saying, I would like your checklist or something, and you will get it from there, and it doesn't add you to my mailing list. The way to help me is, as always, be honest about your deals. So whether you're on the active side or passive side, I'm really hoping that several of us can band together and save other passive investors or capital raisers from doing business with the wrong sponsors who are only concerned about either acquisition fees or giving their own company all the business of construction or property management, and they don't really care whether the deal makes money or not.
Well, Sandhya, thank you so much for being here. Thank you for your time and your wisdom. We really appreciate your being here, and thanks for sharing all of the tips. So
thank you for your honesty as well. I mean, I think there's a lot of, to your point, there's a lot of sunshine and roses out there, right? Especially when people are saying you can make money and it's super easy, but having a real conversation about what can happen and what you need to pay attention to is super powerful.
Yeah. So be really careful where you invest your money. And thank you so much for having me on your podcast. I really appreciate it.
Thanks again for being here. Have a great evening.
You too.
Thank you for listening to this episode of the Real Estate Mindset Podcast. If you've enjoyed the content today, please follow this show wherever you listen to podcasts. And don't forget to head over to wildoakcapital.com for more information or to connect with Eric directly. Please take a moment to leave a review or tell a friend about what you've listened to today. We hope you'll tune in again soon.